Hey everyone, and welcome. Today, we're diving into the complete blueprint for what is truly one of the most crucial skills in finance, portfolio management. Think of this as your architect's guide to building a smarter, more strategic investment portfolio. So, let's get started and lay that first stone.
So here's how we're going to tackle this. We're going to build our understanding from the ground up, just like a building. We'll start with the absolute foundation, return and risk. Then we'll erect the structure with modern portfolio theory. After that, we'll see how it fits into its environment by looking at market risk and beta, put the roof on with the CAPM pricing model, and finally, do a full inspection with performance evaluation. It's the whole journey from data to decision.
I really want you to keep this image of an architect in your mind today. You just can't build a strong skyscraper by starting with the windows, right? You need a solid foundation before you can put up the walls, and you need sturdy walls before you can add the roof. Every single concept we cover today is going to build logically on the one before it, creating this complete, powerful blueprint for managing investments. Okay, let's pour that concrete foundation. Every single investment decision you could possibly make, no matter how complicated it seems, really just boils down to balancing these two things: the return you hope to get and the risk you have to accept to get it. First things first, return. How do we even calculate it? Well, it kind of depends if we're looking backwards or forwards. To see how an investment has done, we use historical data. The formula is pretty straightforward. You just take any dividends you got, plus or minus the change in price, and divide all that by the price you paid originally. But for the future, well, we don't have a crystal ball, so we use probabilities. We'll say, okay, there's a 30% chance of a boom, a 50% chance of normal times, and so on. We calculate a weighted average based on those odds, and that gives us our expected return. Now, what about risk? In finance, risk is really just a fancy word for volatility. It's how much an asset's return jumps around its average. To measure it, we first see how far each return is from that average. But wait, some of those differences will be positive and some will be negative. They just cancel each other out. So to fix that, we square every single one to make them all positive. The average of those squared numbers, that's called the variance. And for the final step, to get back to a number that makes sense, we take the square root. And boom, that's the standard deviation, our number one measure for total risk. Okay, our foundation of risk and return is set and solid. Now we can start building the actual structure. And this is where the genius of Harry Markowitz's modern portfolio theory, or MPT, comes into play. It's this incredible idea that you shouldn't just look at stocks in isolation. The real magic is in how they work together in a portfolio. So to understand how assets play together, we first need a measure called covariance. I want you to think of it as a bridge that connects two different assets. It tells us the direction of their relationship. If it's positive, they tend to move in the same direction. One goes up, the other tends to go up. If it's negative, they tend to move in opposite directions. It's the raw score of how they dance together. Now, covariance is useful, but the numbers can be kind of all over the place and hard to interpret. So we do something really smart. We standardize it, and we get the correlation coefficient. This is amazing because it always falls in a neat little range between -1 and +1. +1, they move in perfect lockstep. -1, they're perfect opposites. And here is the secret sauce of diversification. As long as two assets have a correlation that is anything less than a perfect +1, combining them will actually reduce the overall risk of your portfolio. That's the key. So what does this look like in a formula? Let's take a simple two-asset portfolio. The total risk is not just the average of the two individual risks. Look at the formula. It's kind of like the old A plus B squared from math class. You've got the weighted risk of asset A, the weighted risk of asset B, and then this absolutely critical third piece, the interaction effect, which is all about their covariance. This is where the risk reduction happens. If they're perfectly correlated, there's no reduction. But if they are negatively correlated, you can actually start to eliminate risk. Now let's scale this up to 3 assets and see what happens. The logic is exactly the same, but you can see how the math starts to expand. You still have the individual risks for A, B, and C, but now you have to account for the covariance between every single possible pair. That means you need A's relationship with B, B's relationship with C, and A's relationship with C. You can imagine that as you add more and more assets, the number of these relationships you have to calculate just explodes. So after you run all those calculations for every possible combination of assets, you can plot them on this graph. And what emerges is this beautiful curve called the efficient frontier. This line represents the absolute best of the best portfolios.
Here's what I mean. For any level of risk you're willing to take, the portfolio on that line gives you the highest possible return. Any portfolio below the line is just inefficient. Why would you ever pick a portfolio down here when you could go straight up and get a better return for the exact same risk? You wouldn't. A rational investor always wants to be on the frontier. Okay, we've built our portfolio structure. It's optimized, it's on the frontier. But, this building doesn't exist in a vacuum. It's out there in the real world, in the wider market environment. So now we need to understand the external forces that are going to push and pull on it. I love this analogy. It's a really simple way to get this. Think of market risk or systematic risk as the tide. When the tide comes in, it lifts all the boats. When it goes out, all the boats go down. You can't escape the tide. Then you have company risk or unsystematic risk. That's like the condition of your specific boat. Maybe it has a leaky hull or maybe it has a brand new engine. That's the risk you can actually do something about. So let's put some official names on those ideas. The total risk of any stock, that standard deviation we calculated way back at the beginning, is made of two parts. You have systematic risk, which you can't diversify away. This comes from big picture stuff like GDP, inflation, interest rates. Then you have unsystematic risk, which you can diversify away. This is all the company-specific news, like a product recall or a new factory opening. And here's the amazing part. By building a portfolio with, say, 15 to 20 different stocks, you can theoretically eliminate almost all of that unsystematic risk. You're just left with the risk of the market itself. So if a well-diversified portfolio is only left with that systematic, market-wide risk, how do we measure it for a specific stock? The answer is beta. Beta tells you how sensitive a stock is to the movements of the overall market. If a stock has a beta of exactly 1, it moves pretty much in line with the market. If its beta is greater than 1, it's more volatile. It's an aggressive stock. And if its beta is less than 1, it's less volatile. We call that a defensive stock. This is a huge step. We now have a precise measure for the kind of risk that you can't avoid, beta. So the next logical question has to be, what return should I be paid for taking on that risk? And that, my friends, brings us to the roof of our structure, the Capital Asset Pricing Model, or CAP. The CAPM formula is just so elegant. Here's how it works. It starts with the risk-free rate. Think of this as the return you could get from a super safe government bond. Then we add a bonus, a premium for taking on extra risk. And how big is that premium? Well, you take the stock's beta and multiply it by the market risk premium, which is just the extra return the overall market gives you above that safe risk-free rate. So the big idea here is that CAPM tells you the fair return you should require from an investment, given its specific level of market risk. Now, if you plot a stock's returns against the market's returns, you get this line called the characteristic line. The steepness or the slope of that line, that's its beta. But look at where the line starts on the vertical axis. If it starts above 0, that little intercept is called alpha. Alpha is the abnormal return. It's the return that isn't explained by the market. A positive alpha is the holy grail for portfolio manager. It suggests they've generated returns above and beyond what was expected for the risk they took. All right, our building is complete. We have the foundation, we have the structure, we have the roof. What is the final step for any good architect? It's the final walkthrough, the inspection. We need to measure how well our portfolio actually performed. So how do we grade the performance? The very first question you have to ask is this portfolio well diversified? If the answer is no, then that investor is being exposed to total risk, both the market risk and all that company-specific stuff. So in that case, we use the Sharpe ratio because it has total risk, standard deviation, in the denominator. But if the portfolio is well diversified, then all that company-specific risk is gone, and we only care about the market risk they were paid to take. So then we use the Trainer ratio, which has beta in the denominator. They both measure risk-adjusted return, but you have to use the right tool for the right job. Another fantastic tool is Jensen's Alpha. This one asks a very blunt question. Did you beat the benchmark? It's simple. You take the portfolio's actual return and subtract the return that CAPM predicted it should have earned based on its beta. If that number is positive, you beat the benchmark. Congratulations. If it's negative, you underperformed. It's a clear, absolute measure of performance. We have covered a ton of ground. I mean, we've gone from the tiniest building block of a single stock's return all the way to evaluating a fully constructed portfolio. So let's just take a breath, summarize, and then peek at what might come next. Our entire beautiful building has been built on the CAPM model, which has one big assumption, that only one thing really drives returns, and that's the overall market. But what if life is a little more complicated than that? Well, that's where a more advanced model like the arbitrage pricing theory, or APT, comes in. APT says, hey, maybe returns are influenced by multiple factors, like shifts in inflation, or GDP growth, or even oil prices. Each of those factors gets its own beta, making it a much more complex, but maybe more realistic model.
So there you have it. We've walked through the entire architect's blueprint, from the foundation to the final inspection. You now have the tools to understand how to measure risk and return, how to combine assets to lower that risk, and how to grade the final product. You have the blueprint. So the final question is really a personal one. Armed with all this knowledge, how will you decide which risks are truly worth the reward?